that whatever number of registrations are there, we should give, because they are interested in the registration number or the identification number, and they would have whatever objectives that they must have got behind bringing this particular provision. And therefore, every registration number that the SSE has for whatever locations that are there in the company, if I was a signatory to the tax audit report, I would provide them. Even registration number under other indirect taxes. Yeah, so like excise duty, service tax. So any other indirect tax, like you may have question is profession tax covered under indirect tax, or is it covered under a labor law? So profession tax, luxury tax, entertainment tax, local body tax, etc. All these kind of taxes we will have to report. Clause number 8 requires the tax auditor to mention under which clause of 44AB has the audit been conducted. So as we are aware, there are 4 clauses under 44AB under which the tax audit can be conducted. I was just trying to find out why they are asking for this information and can there be a problem. And I thought of one problem, that many times there is a dilemma as to whether the assessor is doing business or is engaged in any profession. And in those kind of cases, you may have a grey area, and the issue of coverage of 44AB may come into picture, because the limits of turnover are, as we all know, different for both the categories. So there could be a case, and a lot of people are misusing this kind of situation in the way that, for example, the turnover or gross receipts is say 30 lakhs. So it is more than 25 but less than 1 crore. So if you are a businessman, you are not covered by 44AB. Your due date for filing the return would be therefore 31st July and not 30th September in the normal course. But if you are a professional, then you are covered by 44AB, then your due date becomes 30th September. So a lot of smart people, they missed out on filing the return by 31st July. So they took a stand that I am a professional, my turnover, my gross receipts are more than 25 lakhs. So 44AB is applicable. So get the 44AB done, audit done, and file the return by 30th September, and you thereby try to get out of the hardship caused by not filing the return within the prescribed time limit. So this was happening, and I think that the maybe an unlikely outcome of the change which has come about now in terms of reporting which clause you are doing the audit under, maybe that they will try to catch you with whether actually 44AB is applicable or not. And here we may just keep in mind that in the ITR form, also there is a particular field where you have to give the code number of the principal lines of business, in one of the particular sections, and the list is provided. I don't know whether the software at the back end in CPC has got the capability of comparing that particular code number with what you write over here in terms of clause. So for example, you put in over there, you write something relating to business, and here you say I am doing the tax audit under the clause applicable to professionals. Will they compare, will they try to link the thing through the help of software? It's extremely easy for them to do that. If they do that, then all the people who are misusing these provisions and trying to get out of that, just in the example that I gave, will get caught, and will therefore need to be extremely careful. So this, the relevance of distinction between business and profession, we need to be very careful about that. What constitutes business, what constitutes profession. Some case laws are given, I will not get into that for lack of time. And it is not even relevant in the context of the change as such. Clause number 11, books of accounts. We need to provide the address at which the books of accounts are maintained. If more than one location, address of each location and books maintained. There is no format prescribed, so we were anyways reporting in some particular tabular format. So we will continue to do that, but we'll have to add the address or the location. But along with the list of books of account, what is added this year is the words in red and nature of documents. So list of books of account and nature of document examined by the tax auditor has to be reported by the tax auditor. So one option, the one reason for asking for the address could be that at the time of search survey, they may want to plan properly in advance based on whatever information you are giving. and go to all the locations that you have voluntarily reported. The problem that in the current context, in today's context where everything is electronic, where a lot of businesses are maintaining books not in their own computers but maybe on a server. The server may be located in the office of VSNL or BSNL, or it may be located in a foreign country, or it may be located in the cloud. So these are the issues that will arise as to if your server is not in your office but in, say, somewhere in the cloud. What do you report as the location? You can't write cloud. So you have to figure, these are the things that we will face. We will have to be careful, we will have to find out. In the context of SAP, again the problem will arise. The different modules may be located at different places. Factory may be having, the factory related module. The administrative office may be having the administrative related module, etc. So all those things will have to be looked at by the tax auditor and accordingly reported in this particular clause. The other important change, as we saw, is the nature of documents. So a lot of people are asking, what do you mean by nature of documents? I was just trying to think what I would write if I was auditor. My view is that they have not asked for list of the documents. So they are asking list of books of accounts and nature of documents. Therefore, and in the course of our audits, obviously we would look at a whole, lot of documents. So it's obviously impossible to try and list down all the documents individually. So you are required to only categorize on the basis of the nature of the documents. I just thought, how would I categorize if I were to sign a particular tax audit report? I just thought of this, that one category of the nature of the documents could be bills, stroke invoices, stroke receipts, issued, stroke received by the SSE. So that will cover all your purchase bills, all your expense bills, purchase bills, etc. All the expense invoices that you collect from all your vendors, etc. Then credit notes, debit notes issued or received by the SSE. Statutory registers maintained under various laws. So all your Companies Act related registers, all your excise registers, the labor law registers, the provident fund registers, everything would come under this particular nature of documents. Contract stroke agreements entered into by the SSE. Correspondence between the SSE and others. Third party confirmations stroke statements of accounts. So if you have loan confirmations, if you have bank confirmations, if you have stock confirmations, if you have a distributor confirmation or a commission agent, whatever, all those confirmations of all kinds could then fall under this particular category. So these are just my suggestions. Anyone is free to add to these or discard these. But I thought that if we have to report nature of document, this is the way one could go about it. Of course, we need to wait for the Institute's guidance note, which I am told is expected around 27th, although that is not an official intimation that I have got. But in all likelihood, by 27th evening, we should get the guidance note from the Institute. There is a council meeting on 27th where they are going to take it up. Clause number 13, effect of change in method of accounting on P&L to be given. Gross impact to be disclosed, net effect cannot be given. So earlier we were just mentioning the net impact of the change in method of accounting, but now we will need to give both if there is an increase in profit or a decrease in profit. The question that arises is, what if the impact cannot be quantified? Can we write nil? Now, it all depends on the schema of the utility that they have uploaded. If for example, the question is there a change in method of accounting? And if you say yes, then if they really want to be nasty with the auditor, the schema will not allow us to put 0 over there. So we'll have to wait and see, test out the schema and see whether you can apply, you can put nil amount in the particular table provided. We may also keep in mind the distinction between method of accounting and the accounting policies. That distinction remains. So only change in method of accounting is to be quantified and disclosed, and not the impact of any change in accounting policy. Clause number 14, effect of change in method of valuation of stock on profit and loss account. Again, gross impact to be disclosed. net impact, mere reporting of net impact is not permissible. So same way, increase in profits, decrease in profits. Clause number 17, value adopted or assessed or assessable by any authority of a state government referred to in 43 CA or 50C to be reported. This is a big problem for all of us. The reporting will be required under this clause if the following conditions are cumulatively satisfied. A, the assessee has transferred land or building or both. The transfer is during the relevant previous year and consideration for transfer is less than the value adopted or assessed or assessable by any authority of a state government. So basically less than the stamp duty value. So if all the three conditions are cumulatively satisfied, then the section will apply and therefore reporting will be required. The reporting is required in this format: the details of the property, consideration received or accrued, value adopted by the stamp authorities. The problem that may arise is that many times we have individuals as our clients where the tax audit is being done, say a doctor or an architect or a lawyer or even a chartered accountant, and that professional maintains common books of accounts. So he has only one bank account where all his personal income and expenses are, income goes in, expenses go out, investments are made from that, etc. So the question that arises is that if there is a sale of a personal asset of the SSE, but routed through the same books of accounts, which are subjected to tax audit, then whether the tax auditor needs to report that particular item over here or not. So my personal view is that they are not asking about the capital gains or the business profits earned by the SSE. They are asking only information about the properties where 50C or 43CA would be applicable. And therefore, in this kind of an example, I would feel that the reporting will have to be done. Of course, if the books are separate, so if the SSE, the concerned professional, has two bank accounts, one forming part of his professional receipts and the other which is not in the books of accounts, for which no books are maintained, and in which all the income from other sources goes, then there is a possibility, not possible, it is obvious that what does not form part of your books of accounts, and therefore what does not form part of the tax audit is not required to be reported over here. In case of unregistered documents, ready reckoner value to be adopted, that was the question. So, the question of stamp duty and the assessment, etc. arises when you give the document to the government. But if you have not given it for registration, what happens? Those issues which are anyway we are facing for the purposes of the section continue, and we will have to grapple with the same as tax auditors. Whether sale of TDR will be covered, again, it's a debatable issue. So whatever stand that we are taking for tax purposes, the same would obviously have to be adopted for the tax audit purposes. The biggest controversy is whether, yes.
Here he says it is to be reported only if it is less than the assessed. If it is unregistered, then it is not assessed. Then it is not to be reported.
Yeah. I'm saying that there is a controversy. What I'm saying is the controversy is anyway there on the section. I'm not talking about the report. I'm saying there is already a controversy about the applicability of the section. So whether to report it or not, we have to take a stand. Then the transfer, whether the transfer has taken place in the year or not, is sometimes an issue. So that controversy we will have to deal with. Controversy on applicability in case of land building forming part of the block of asset. So what happens is that in case of business, you have a block of assets for depreciation purposes. It consists of office premises, building, and some part of it is sold. And when it is sold, the sale price is reduced, as we are aware, under section 50 from the WDV. After that, if it is negative figure, it results in a deemed short-term capital gain, which needs to be offered for tax. So the question is whether the applicability is there in case where it is not negative. So block continues, there are assets which continue, there is a positive balance left. Will the 50C or 43CA be covered? Again, going back to the earlier discussion, that what is required is only the information about the whether the stamp duty value is higher than the agreement value. So in such cases also I would feel that we would need to disclose, but here I am sure that there are people who may differ. But my view is that we should disclose. Clause number 20, contribution received from employees towards the fund as per 36(1)(5)(a), one additional column for actual amount paid to the concerned authorities. So you recover money from from the employees contribution to PF or any other kind of fund. So that the disclosure was already there, but an additional column of actual amount paid has to be mentioned. Coming to clause 21, which is the earlier avatar is clause 17. It's caused a lot of issues. Earlier, if you see clause 17, it read, the heading, the clause started with the words amounts debited to the profit and loss account being, and then ABCD, EFG, etc. was there. So the entire clause talked about amounts which were debited to profit and loss account, and therefore we did not report what was not debited to P&L account. Now in this new clause number 21, the renumbered clause 21, the reference to debited to P&L account is there only for some of the sub-clauses. So it starts with 21 subclause A, amounts debited to profit and loss account being a few items are there, advertisement, etc., donation to political party and that kind of stuff. So does it mean that in the other sub-clauses where the words amount debited to profit and loss account is not mentioned, does it mean that in those cases you have to report even if it is not debited to profit and loss account? So let's look at that particular issue. So as far as the clause 21, the sub-clause A is concerned, the same earlier items which were there in the past are there. 4 or 5 items are there. I will not get into that. But for 21B talks about amounts inadmissible under section 40A. 40A is a big problematic question. Sorry? So his question is in clause 21A. Yeah. So I was hoping nobody remembered. Please furnish. I am reading out. Please furnish the details of amounts debited to the profit and loss account, being in the nature of capital, personal, advertisement expenditure, etc. So the friend's question is what is the implication of the word etc. Now I would feel that even though the word etc. is there, if you see the items which are given in the table, so what has happened is that some of you may have the printout of the 3CD, in the table is blank, because originally in the 3CD that they had uploaded, the table was blank. And now if you download, the table is filled up. So if you see the latest 3CD, I hope this is the latest one, the items are mentioned and there the words etc. I think has been removed. So if you see, first is capital expenditure, personal expenditure, then advertisement expenditure in any souvenir, brochure, tract, so etc. published by a political party. So the items are clearly mentioned over there. There is no etc. It is exactly same as the earlier reporting requirement. So I would feel that there is no issue about that, because while the heading may have the word etc., but what is actually to be reported, and probably the schema, the utility will also have the same thing. There is no case for any ambiguity. Amounts inadmissible under section 40A, details of payments to non-residents for interest, royalty, FTS or any other sum chargeable to tax on which tax is not deducted, and where tax has been deducted but has not been paid before the expiry of time under section 200 subsection 1, and details of all payments to residents on which tax is not deducted and tax has been deducted but has not been paid before the expiry of time under 139(1). So before the so we have a situation where for AY 14-15, as far as NR payments are concerned, the due date is under 200 subsection 1, and under for payments to residents it is before the due date for filing the return. the Finance number 2 Act, the latest budget of Mr. Jaitley has amended as far as the residence is concerned, they have brought in even the salary payments. So of course for AY 15-16 it is not relevant, but next year when we do the audit, we just need to be careful. So 21B requests us to report the date of payment, the amount of payment, nature of payment, name and address of the payee, and amount of TDS if any. 21D, 40A3 and 40A3A reporting requirements. In the past, in the clause, there was a question asked that whether the certificate has been obtained from the SSE. So that has been done away with now. And so the deemed income under 40A3A is now also required to be reported. And the format is prescribed for reporting as serial number, date of payment, nature of payment, amount, name and PAN if available. Both the reports to be based on examination of books of account and other relevant documents stroke evidence. So does it mean that auditor cannot merely rely on the SSE certificate? In the past, when that question was not there, that has a certificate been obtained, we were giving a different kind of disclaimer. And from last year or 2 years back, whenever that provision came for certificate, we changed the note put over there. So is it now time for us to go back to the note? That, for example, 40A3 talks about payments otherwise than by an account paying check and the demand draft. So we were earlier saying that the necessary evidence is not in possession of the SSE himself or itself, and therefore we are unable to verify that. That position continues, because if you issue a check, you are anyway not going to get it back in the normal course. So should we go back to the old position and repeat that note again now? We will have to figure out, we'll have to see what the institute guidance note says on this. But I would feel that just because the requirement or the question which was asked earlier, that have you obtained the certificate, has been removed, that does not mean that we do not have the right to obtain that certificate. So we will definitely have to get all the management representation or the whatever we call it from our client for our protection. But we may not have the opportunity of reporting it in the particular format that they have given. However, in the notes, in the audit report, etc., wherever you are putting all your disclaimers, I think their reference can be made to the representation that we have taken from the SSE. Sorry? Yeah. No, but so see, the TDS returns will. This question is about the tax payment, cash payments. So, I don't. Okay, clause number 28, income under 56 to.
In cash payments, NEFT and e-transfer are not.
I was hoping that this was not asked, but it is asked a question about NEFT transfers. So, under Rule 6B, 6DD, that exception is there. The electronic transfer is covered.
Now it is covered in
Not in this.
No. In Rule 6DD it was always there. In 269SS and 269T, the amendment has now come. But for 48.3 it was always there. So we checked up. So I am quite confident about that. So we don't need to worry about that. But 269SS, so since you brought up the topic, I'll jump to 269SS and T. And there, as you are aware, the budget has brought an amendment about the electronic repayments or acceptance. I am hoping that the department therefore does not take a stand that therefore prior to assessment year 15-16, right from 1st April 1962, their intention was always to see that electronic transfers are, you cannot give or take loans by electronic transfer. I hope that does not happen. Finance Minister has said he is not comfortable with retrospective amendments. So I hope that retrospective interpretation will also not happen. But anyway, coming to clause 28, income under 56-78, applicable only to firms and closely held companies. And the report is, what we have to report is whether during the previous year, the SSE has received any property being share of a company other than a company in which the public are substantially interested, without consideration or for inadequate consideration, as referred to in section so and so. If yes, please furnish the details of the same. So here we are now expected to report about the the deemed income under section 56. The valuation as under this section of 56 to 7A is to be done as per rules 11U and 11UA. It is possible that the valuation has already been done by some other other chartered accountant. So the tax auditor will therefore, the question is, should you rely on that report or certificate, or you do your own certificate, own valuation? There is institutes, guidelines on using a third party, the other auditor reports, etc. So obviously, when another chartered accountant has certified it, you can rely on it and mention the fact that you have relied on the certificate dated so and so, issued by so and so in your 56, controversy whether the SSC has received, the controversy where the SSC has received shares by way of right issue, bonus shares, allotment of shares by company, conversion of debentures, buyback of shares on amalgamation, buyback of shares, then on amalgamation or demerger, or on dissolution of a firm, etc. All these issues are there, which we were facing for tax purposes. Now we are facing them for the tax audit purposes.
Only private limited company.
Yeah.
Not listed.
Yeah.
Not being a special interest.
Yeah. Of course. So there is no format prescribed for reporting under this clause, under clause 28. So we will have to see in the schema what kind of reporting requirement is there. Probably the report, the table will look like this: date of receipt of the shares, name of the company whose shares are received, number of shares received, consideration paid, fair market value of the shares, and difference, if any, between the two. So probably this kind of reporting requirement may be there, but we'll have to check the schema. Clause 29, income under 56 to 7B to be reported, applicable to companies. Whether during the previous year the SSC received any consideration for issue of shares which exceeds the fair market value of the shares as referred to in 56 to 7B. If yes, furnish the details. Again, no format prescribed. The same rules 11UA, 11U and 11UA would be applicable, and the same issue of relying on other chartered accountant certificate will arise. At the same time, we must keep in mind that this 56 to 7B does not apply to a venture capital undertaking receiving consideration from the venture capital fund or the venture capital trust. So that is specifically excluded under the section 56 itself. Therefore, that should not be reported. Also, only money received from residents is covered. The auditor will therefore have to verify whether the person who gave the money to the company, the shareholder, whether he is a resident or not. The question is whether the residential status is on when. I would feel that obviously for the year, because he can't be resident on a date, he has to be resident for a particular year. So for the assessment year 14-15, if that shareholder who has given money to the company by way of subscription is a resident, and where the fair market value is higher than the amount paid by the shareholder, then this particular clause of section 56 will be applicable. 31, clause number 31, 269 SS and 269 T. The last clause, subclause C, has been replaced. Before the change, it asked you whether you have obtained the certificate from the SSC. Now, whether, so what is to be reported is whether the taking or accepting of loan or deposit or repayment of the same were made by account payee check drawn on a bank or account payee bank draft based on the examination of books of account and other relevant documents. So we have to base the report over here not on the certificate from the SSC, but on the basis of the examination of the books of account and other relevant documents. The reference to the SSC certificate has been done away with. At this point, I just thought of mentioning that we chartered accountants have over the years brought about a lot of disclaimers and notes in the PCD. And we must now realize that every time we do that, the department is getting back to us or getting back at us with changing the format. So we brought in a note about 48.3 saying this, possession, not in our possession, etc. certificate from the SSC. So they have brought in here. Remove that. You write whether you have verified or not. For loans and accepted, loans given, etc. Again, we were, putting the note that based on the certificate issued, everything is all right. So they've done away with that. we need to pause here as a profession and think that